Well, today's economic growth numbers tip us into recession. Can you believe this property price bounce back? And Paul Rickard's hot post-earnings stock. I'm Peter Switzer.
I'm Paul Rickard.
And we're mad about money. Well, that was a pretty ordinary start, Paul. So
That was a great start, Peter.
start. Well, today's economic growth. On Tuesday, we thought the inventories, they were falling. They could push us into possibly a negative number today. But then the trade numbers came along and the current account surplus first since 1975.
I think people should be bringing out the champagne corks or getting the champagne out, Peter, because
The Krug.
people have got really short memories. In the 1980s, this was, remember the Keating line about the recession we had to have? That was all about the twin deficits, in particular the current account deficit.
Yes.
In other words, the Australian economy was stuffed,
Yep.
was never going to get up again, exports
Correct.
were never going to grow. We were going to be a debtor nation for the next
A banana republic.
Banana Republic, right? And here we have, all these years later, we are suddenly a current account surplus the first time since 1975.
Yeah.
And did you see the ABC or the Fairfax paper press get excited about this? The AFR, to their credit, this morning had a good article about it. But
There's not enough excitement, is there?
People have got such incredibly short memories. This is a huge turnaround thanks to the investment of partly in resources boom, but also all the investment in LNG and other things.
But also, Paul, we now export education, hospitality, tourism, all that sort of stuff, which we never had before. Our economy has changed because of all the reforms that happened over Hawke, Keating and Howard.
And to credit of Hawke and Keating and others, I mean, one of the biggest drags on the so-called current account deficit wasn't the trade situation, it was what was called our net income deficit. In other words, we paid a lot more to overseas people.
We borrowed a lot overseas, the interest had to go back.
Interest and dividends and insurance and all those expenses. And the trend now is our net income deficit is actually coming up towards zero.
And we can thank superannuation
And we can
funds.
largely thank superannuation, all the people that have invested offshore, because now Australians get more dividends from offshore than we pay out overseas. So there's been a huge turnaround. People should actually be celebrating this, Peter. I'm excited about this.
And Paul Keating should get a Christmas card because he was the super
He
guy.
should get, and maybe that'll mean we won't, when the GDP number comes out today, we'll be more like around about 0.5 or something. But
Okay.
all this scary talk about recession, Peter.
Okay.
Look, it's time to as I said, celebrate.
You heard the bill.
Yep.
Now, what about this property price bounce back? We've got a new property show. If you go to Google, YouTube and Switzer TV, you'll see it. I interviewed the guy who was on 60 Minutes and said that there'd be a 40% fall in house prices, Martin North, and Martin is now saying, well, that was one of his scenarios, and he doesn't think that's going to happen unless there's a world economic recession.
And credit where credit is due, Peter. We tipped it, right? We said in the first quarter of this year, property was going to be a buy in 2020.
Yeah.
Probably some ideas about what would happen after the election with the Labor Party getting in, but nevertheless, the RBA, interest rates, look, property's never fallen by 40% in Australia in any of the data. It's gone about 12 to 14%. Typical fall. That's what you saw in Sydney and Melbourne, and we said the property market was going to be a buy.
Yeah.
I'm a bit surprised by the bounce back.
Me too.
The extent of it. It's a very thin market, not a lot of supply, so I'd be a little more wary. But look, property is still more on the buy side than the sell side. Yeah. But I think as we get some more stock onto the market in spring, we might just see a little bit of tempering. But look, the property market, I think it's going to just bubble along. And that's what
it won't bounce back to the boom of 16.
And that's what classically it's done. It's had a very sheep. It tends to go up very quickly over 3 or 4 years. Quite a sharp drop, and then do nothing for about a decade. Yeah. I reckon we're in sort of this bubbling along part.
Yeah, well, Maura and I went for a massive walk last night, and the number of signs out the front of homes indicating people who wanted to sell and didn't sell are starting to. So the supply will increase, and I think it'll put a lid on this new house.
Yeah. And that doesn't mean, look,
back.
we talk about these numbers, of course, the property market is a million individual markets, right? What's happening in your street or your suburb or your units versus houses is totally different. You've got to get really careful when all this aggregate data comes in and says prices are going to fall by 40%. Yeah. But historically, they've fallen by about 12 to 14%, and then they sit and don't do a lot. I think we're going to be in that sit and not doing a lot over the next
Have a look at our new
months.
property show. Martin North talks about, Charles Tarby, the founder of Century 21, he talks about it as well. It's a pretty good show. Finally, Rickard's hot post-earnings stock.
Well, I was going to say, I'm feeling a bit cold about the market, Peter, so I think September's going to be a bit tricky. But there were probably three standout reports in reporting season. One was CSL. I think you've just got to have CSL in your portfolio.
Buying the dip.
Buying the dip, right?
It's expensive.
A second was Zero for its growth. It is still growing. It's expensive. And again, I'd probably mark that down as a company to buy in the bit of the pullback. Maybe if you're a bit more courageous, you just jump in there.
It'll probably do well over the next 5 years. It's a pretty good price.
And the third, I think as it gets to the US, could be a bit more challenging, but let's just see how it goes there. And the third, of course, is WiseTech Global. Now, it's probably the standout earnings report, revenue and profit up about 40%, the same sort of projection for 2020. The only problem with it is it's trading on historic multiples of last year's PE of about 200 times. This year's of about forecasted about 150 times, and the year after that it's about 100 times. So look, it's courageous stuff to buy it. I can't bring myself to be courageous, Peter. I'm sorry, I'm a wimp. That's partly because I feel a little cold on the market.
And you're a wimp because you don't like being poor. But
I don't like being poor, no.
It's a very good company.
I like holding on to my capital. And I think sometimes you've got to be patient, but they're probably the three standouts from earnings season.
Yeah, and I can only give you a risky stock.
Yep, you give us a risky stock.
The risky stock is Blackmores. It's a very good brand. The Chinese Diageo have stopped buying it, but it's still one of the best brands in the vitamin space. I think vitamins are growing at a rate of knots. I think, given this current share price, where it's now, it's got a new CEO, I think it's more likely to improve, but it might take a couple of years. That's a good quality.
I'll throw another one on there. I think A2 Milk is more a buy than a sell, Peter, but I think it's been hit a little bit hard, but that's another one to look at.
Exactly right. I'm Peter Switzer.
I'm Paul Rickard.
And we're mad about money.